recently, as the U.S. stock market has been sluggish due to the aftermath of former President Trump's tariff policy. Global investors' attention is quickly shifting to emerging markets. Major financial institutions on Wall Street are also competing to pay attention to investments in emerging countries.
According to Bloomberg, the S&P 500 index, the representative U.S. stock index, rose only 1.3% as of May 16 this year, while the MSCI Emerging Markets Index surged nearly 9%, showing a large gap. This is in contrast to the overwhelming rise in the U.S. stock market over the past few years. For example, looking at the rate of increase since March 2020, when the COVID-19 pandemic was at its peak, the S&P 500 rose 130%, while the MSCI Emerging Markets Index rose only 38%. Recently, funds have also been pouring into emerging markets. The amount of money flowing into emerging market ETFs for the week ending May 9 was $1.84 billion, or about 2.5 trillion won in Korean currency, more than doubling from the previous week. The background to this change is the Trump tariffs. Former President Donald Trump's unilateral tariff policy has increased market uncertainty, causing U.S. stocks, Treasury bonds, and even the U.S. dollar to all weaken. The temporary U.S.-China tariff truce has somewhat calmed the anxiety, but the Sell America movement is once again emerging after Moody's downgraded the U.S. national credit rating from AAA to A1 on the 16th. Amid this, investors are turning their attention to alternative assets, such as the yen and the euro, as well as emerging markets. Major Wall Street institutions such as Morgan Stanley, AQR, Bank of America, and Franklin Templeton are also paying attention to emerging markets. A strategist at Franklin Templeton said, major emerging countries such as Korea, Turkey, and Saudi Arabia have solid fundamentals, adding, they have low external debt and a stable debt to GDP ratio. A Morgan Stanley strategist also said, now there is a catalyst for the emerging market rally, and analyzed that the weak dollar can explain 1/3 of the emerging market returns. BofA predicted that emerging markets will be the next bull market, and AQR predicted that the emerging market return will reach an average of 6% per year, based on a long-term investment of 5 to 10 years. This is higher than the U.S. stock market return in dollar terms. Meanwhile, the stark difference in return between the Hong Kong and mainland Chinese stock markets is also noteworthy. The Financial Times reported that from January to May 16 this year, the Hong Kong Hang Seng Index rose 16.4%, while the Chinese mainland CSI 300 Index fell 1.2%. This is the largest return gap since the 2008 financial crisis, and analysis suggests that this is due to the inflow of Chinese mainland funds into the Hong Kong stock market due to the AI startup boom. In particular, the fact that major technology stocks, such as Alibaba and Tencent, are listed in Hong Kong or the United States has also had an impact. However, experts also warned that emerging market risks, such as political uncertainty, regional crises, excessive stock issuance, and high trading fees should be watched out for.
From tariff uncertainty in the U.S. to a weak dollar and a change in Wall Street strategy, emerging markets are coming to the forefront again. But that requires cool-headed judgment and risk management.